How we getting on, people? Luke here from LAGFX. We're back today with a new video. In today's video, what we're going to be doing is doing a full case study on the Euro US dollar, and we're going to be doing our predictions for 2024. There's a few of these that are going to be posted and uploaded onto the YouTube channel. We will probably do XAU USD, Great British Pound to the US dollar, and NAS. They will all be separate videos, just so you guys can see exactly what it is that I'm looking for in the coming weeks, months, and the entirety of 2024. And then with that information, you can, apply that to your own charts, have that as a bias, and I guess monitor how my predictions play out in the coming months. Now, if you're new to the YouTube channel and you enjoy this video, don't forget to subscribe. We post videos on a weekly basis, giving you guys up-to-date analysis within the Forex markets. And if you do go on to enjoy this video, don't forget to leave it a thumbs up. If you have any feedback regarding the analysis we go through today, if there's anything you're unsure about, whether it's something I've spoken or touched on, then please leave them in the comments below. We appreciate all types of feedback, and we are more than happy to create videos surrounding anything you may be struggling with understanding. Now, just to track back, as I said, we are going to be doing a full top-down analysis on the euro to the US dollar market. I'm going to be giving you my technical bias based on technical analysis. No fundamentals are involved within this analysis or the bias that I will come up with. This is purely based on supply and demand and price action. Those are two of the things that I look at when I complete my technical analysis within the markets that I analyze. And then to further add to our bias and the confluence that we have, we obviously look at fundamentals and ensure that they are also in line with what we are looking at. Now, if you've watched a case study video on this channel, you'll know that we always start on the highest of timeframes, just so we can see right the way back to the early 2000s, just so we can kind of see exactly what the markets are doing, with us being able to have a greater understanding on the overall structure of the market. This helps us define a bias, a direction that the market is heading in. So when we look at this market, if we just go to the 3 months, actually, it shows a lot more clearly. So you can see here, if I just get my path tool, or my brush, should I say, we have a low that's been set, followed by a high, and what we can see here is price looks to be setting a new higher low. So just based on these 3 structural points, my bias is to see this market continue now trading us in a bullish way. Now, to add to our confluence and to add to that bias, what we need to find are areas of demand that suggest that price is setting a higher low from this point before continuing to trade higher to set that new impulsive wave, and as a result setting a new higher high. So what we need to be looking for are order blocks. This is something I look for when I look to take part in the markets, as these are footprints that are left over by institutions, and we understand that within high impulse moves or large volume moves, when we see these order blocks left over, we understand that that's based on institutional control. So you can see here that we have a high volume green candle followed by a doji looking red candle, and then a continuation in bullish structure. So this red candle here is what stands out for me. So we're just going to highlight that out as a point of interest, somewhere that I feel price may trade back into. Then as we drag that across, you can see that price trades perfectly into that. What we have seen since price has traded in is that we have bullishness introduced and a new injection of demand. So because of this data, we now have an extra piece of confluence that suggests that price could be setting a higher low at this point, because price has traded perfectly into an order block, an area of interest, and has rejected nicely to the upside. Now, in order for me to look to buy into this market, which I will be, and that's my sole purpose, to be looking to trade with the prevailing trend, which is a bullish one, we need to find key areas of demand to actually enter in from, and we obviously need additional pieces of confluence before we look to get involved in this market. So now that we have the structural points laid out, we have an area of demand that price seems to have respected and rejected nicely from. We can start to digest this information and head down to the lower time frames. So as we head down to the lower time frames, what we should be looking at is the last impulsive wave within the structure that traded us down and into this demand zone, in this case, which is this one. From here, we need to look at the last fractal structural protected high. The last protected high within this bearish structure that traded price lower is the one that set the lowest low. So realistically, we could say that this was the last protected high within this structure fractally, but what we could do is we could go from this one here. So I'm just going to mark this out as the last protected high. Now, the reason why I'm marking this out is because what this defines and what this tells us is that there is enough demand, or enough demand has been introduced into this market to actually break structure to the upside. Now, if you are familiar with breaks of structure and you understand what that tells us, then you will know that having a break of structure in and around an area of supply or demand is a very good sign that price is ready to now reverse. Just to kind of elaborate on that, if we have a bearish market, we understand that the highs are protected and the lows are broken to create a new lower low. So when we see that a high has been broken rather than protected, this suggests that price is no longer following the laws of bearishness and it is now looking to follow the laws of bullishness. Why? Because we break the highs and we begin to protect the lows. So this, by breaking the high, is suggesting that price may be looking to follow the laws of bullishness and trade us higher. As you can see, we've had a break of structure here, and as a result, we have also had the introduction of bullishness. So this, again, further builds our bias that price is not only trading us in a bullish way, but is ready to put in the next higher time frame bullish impulsive wave. So now that we've had a break of structure to the upside, we've had a penetration of a demand zone, clear rejection. What we need to be doing is we need to look at the impulsive wave that broke the structure to the upside, which is from here to here, to find areas of demand that price can pull back to trade into to set a higher time frame, higher low. Why do we want that? Because within this, we understand that if this is a bullish market, we understand that price will trade in a bullish way, setting higher lows and higher highs, just like this, because this is a new bullish impulsive wave, trading goes higher. So we need to find areas of demand that price can pull back into to set that higher low before setting its next impulsive wave, and as a result would set a new higher high. So again, what do we look for? We look for areas that have been manipulated, high volume candles, and some kind of point of interest. An order block, for example. We just move this to the left. You can see here that we have a high volume candle to the upside, but before that we are delivered with what looks to be a hammer. Now this is institutional control. Yeah, again, this is an order block that has been left over for the markets and the institutions to trade from. So what would happen is bullishness and buy orders will be exhausted, and as a result price would begin to trade lower as the market flips. Once price trades into this area of demand, we then have a lot of demand introduced, so demand is injected into the market, and that's what sets that new higher high. So buys are usually offloaded as price begins to trade us lower to correct itself. Once price trades into this area of demand, we then see an introduction of new buy orders that then obviously propel price and trading it higher. So this is an area that we can actually be looking to get involved in buy positions from, and I would be confident in buying into this market now because of the prior analysis that we've completed within this video. Once we have a penetration, break of structure fractally, and rejection to the upside. So now that we have an area of demand that we can look to get involved in buy positions from, we now need to understand whether price is ready to put in that correction to actually trade us lower. So rather than having a break of structure to the upside, we now want a break of structure to the downside. Well, if you look here, this would be the last protected low within this bullish structure. Why? Because this low here created the highest high. Therefore, this is the last protected low. You can see that price has actually broken beneath that and has started trading us in a bearish way. We have the creation of a lower low. Because we have the creation of a lower low, we are starting to see the laws of bearishness being introduced fractally. So again, what do? We look at the impulsive wave that broke the structure. I can see here that there is a hidden order block. You guys may not be familiar with hidden order blocks, but there is a hidden order block within this. We have a wick to the downside followed by a wick to the upside. This suggests bullish activity within a bearish impulsive wave. This is an area that has been left over, a footprint that's been left over. What do we see? Price has traded perfectly into this, and we've had rejection to the downside. Again, this is all suggesting that the analysis we are performing is playing out beautifully. So if we go down on timeframes now, looking at the daily, you'll see that that's the doji that's left over. That was the original order block. That was the original area of interest. We have seen how price did trade in to clear that. But what's of interest to me now is this wick itself, because this wick hasn't been cleared. So that is definitely an area of interest. Why? Because a wick to the upside suggests that bullishness will have had to trade price up to that point before bearishness was introduced. And the wick has been left over because we've had that large move to the downside. So again, this is all adding up perfectly to present us with not only a bearish position to trade us into the demand zone, but also setting us up nicely for that longer term buy in the coming months. We could be waiting until gone May, June time, but this opportunity to go long in this market is definitely there. So as we go down on timeframes now, what do you think our next step would be? Well, we want to look at the impulsive wave that traded price into this area of interest, this area of supply. We want to look at the last protected low. Why do we want to look at the last protected low? Because if we look at the last protected low and that's been broken beneath, we understand enough supply was introduced from this area to flip the market to the downside, to actually set this new corrective wave on the higher time frames, trading us down and into that demand zone that we marked out earlier. So I would actually be confident in saying that this was probably the last protected low within this bullishness that traded us into the supply zone. And I would be happy in saying that this is also a break of structure to the downside. Now, as a result of this break of structure, this tells us that enough supply has been introduced from this area, and we can now start to look for those bearish opportunities to actually trade us down and into that higher time frame demand zone. You'll notice here I've marked out another POI. The reason why is because within this is another hidden order block, and as we go down on the lower time frames, you'll probably see the order block itself. But just to show you, you can see here that we've had a wick to the downside. Now, the wick to the downside will have been bearishness initially, but what's happened is price has traded in a bullish way to actually close up here. We've then had a candle open for the new 15 minutes, and then we've seen price shoot down. We've not had price come to clear any area. So I would imagine that inside of this is some kind of order block. And this gives us an area to enter in on those short positions from. So if we go down to the 5 minutes, as you can see, we are presented with this order block. We can just refine this ever so slightly, but you can see that that order block shows and presents itself to us clearly. So by completing this full top-down analysis, we have been able to completely dissect this market and get a great understanding on what's going on. Based on my technical analysis, I have a longer-term bias to go long, and I would imagine that that bullish opportunity will present itself to us April, May, June time. I can't be dead specific just because I don't know how much volume is going to be introduced. I don't know how quickly the market is going to trade us down and into that demand zone. But I would imagine that price will trade us down and into the demand zone I gave you guys earlier. Enough demand will be introduced, and that will set off the next impulsive wave, trading us higher in a bullish way. Now, before that, price is within a higher time frame correction. So as a result, we can expect this market to trade us in a bearish way moving forward up until price does trade us into that higher time frame demand zone. So what I'm going to do is I'm going to mark out this area for you all, and giving you guys the exact figures so you guys can go ahead and mark this out on the 5-minute time frames. I would suggest going short from this point of interest, from this area of supply, as we've had multiple pieces of confluence to suggest that this market is going to be trading us lower. And then I'll also give you the higher time frame demand zone that we have marked out below for those bullish opportunities. Realistically, we could set our take profit just above that demand zone. It would be an extremely large take profit target. However, it's more than achievable. So I'll be back in just a moment. I'm going to highlight this zone out so you can see the exact price, and then we will come back and do the same with the demand zone. Perfect. So you can see here that I have marked out the increments for you all. What we want to see, just to kind of give you guys more clarity and more depth into my analysis, is we want to see structure break to the upside to suggest this fractal correction to trade into this area of supply. Once price is traded in, we can expect the S&D balance to flip, so the supply and demand balance to flip to the downside. We'll be presented with another break of structure. We will then see price trade back up to set its first lower high before continuing to trade us down and bearish in this market. So this would be the fractal break of structure to the upside, like so. Just to confirm this bullish correction that we are seeing at the moment fractally, this would be the break of structure to the downside to tell us that enough supply has been introduced. And then our entry will come, if we want to be very specific with our entry and very refined, our entry will come from the correction that follows after the break of structure. All we need to do is look at the impulsive wave that broke the structure, being this one here, to find any areas of supply or any order blocks that have been left over for price just to trade back into, to set that lower high before trading goes lower. We can then expect price to trade us all the way down. As I say, this is a very, very large take profit target, but there's nothing to suggest that this isn't achievable. And we want to see price trade all the way down and into this area of demand. From there, we can wait for the confluence to suggest the reversal or the creation of the new impulsive wave, trading us higher, and then we can get introduced in those buy positions. But what I'm going to do now is just mark this zone out for you all, and then you can go ahead and apply this to your own charts. Perfect. So I've gone ahead and marked that out for you all. If you guys want to go ahead and mark that out, absolutely do so. This is definitely somewhere we can look to go long from. Now, just to zoom out and show you the path in price and how I feel price will play out, you can see here price has set an impulsive wave. We'd have a correction to set that higher low, followed by a new impulsive wave to set that higher high. So getting involved in longs here, there's no harm in that. But in order for price to set longs from there, we expect price needs to put in a correction, which it's doing now. It's beginning the corrective phase fractally. So price needs to trade us down and into this before we can obviously take part in those longs. Hence why we are looking to go short now into this area. Again, this may take us to May, June, July time before price then goes on to set that impulsive wave. But the most important thing to take from this is do your due diligence, complete your top-down analysis thoroughly, and ensure that everything you are doing is coinciding and matching one another, basically. It's very important that your analysis is all linking together and it is all following the same bias in the same direction. My analysis here is doing exactly that, and we are seeing, as we go down on timeframes, price is playing out exactly as we are predicting. So I'm definitely looking to go short, as I say, for the first half of the year, probably, in the euro US dollar market. The latter end of the year, I will be looking for those bullish opportunities, assuming price has traded into this demand zone. We've been delivered with a break of structure to the upside, confirmation that price is trading us higher, and then I'll be looking to go long. So shorts before longs on the euro to the US dollar. What I will probably do in the months to come is look back on this video, probably create another video around this, just to see how price has played out. And some of the opportunities that we could have generated or have generated from this market. But that's my top-down analysis based on technicals for the euro US dollar market. And those are my predictions. Shorts before we go long from this area of demand. If you guys have any questions regarding the analysis I've gone through, whether you're unsure about breaks of structure, areas of interest, price action as a whole, leave them in the comments below. As I said, if you've enjoyed the video, leave it a thumbs up. We really appreciate all the support that you guys provide. And if there is a market that you want me to complete a top-down analysis on, like this, leave them in the comments as well, and I'll be sure to create a video around that. I just want to take this time to thank you all for watching, and we will catch you all in the next video.